Hello and welcome to the Mehmi Group podcast. I'm your host Haider Malik, and today we're digging into one of the most common questions owner operators face: lease or buy. Which strategy makes the most sense for financing your truck? Keeping your fleet running smoothly and building equity in your business depend on choosing the path that aligns with your long-term goals, cash flow needs, and operational style. Buying a truck outright with an equipment loan means you finance the purchase price less a down payment, then make fixed monthly payments over a set term. At the end, you own the asset free and clear and can trade or sell it as you see fit. Ownership builds equity which you can tap for future growth or use as collateral for additional financing. Owning also gives you full control over modifications and usage without mileage limits or wear and tear clauses. However, monthly payments tend to be higher than lease payments, and you are responsible for maintenance, repairs, and depreciation. You'll need to manage resale value risk and factor in the cost of disposing or trading your truck when the time comes. Leasing, on the other hand, works more like renting. You agree to pay for the vehicle's depreciation plus financing charges over a shorter term, often 2 to 5 years. Payments are lower and require little to no money down. At lease end, you can return the truck, upgrade to a newer model, or purchase it for a predetermined residual value. Leases may include maintenance packages that cover scheduled service and even repairs for major components, reducing upfront costs and simplifying budgeting appeal to owner operators who prefer predictable expenses and who plan to upgrade frequently. The trade-off is you never own the truck outright unless you pay the residual, and you must adhere to annual mileage limits and condition requirements that can trigger extra fees. When comparing lease versus buy, cash flow is the first consideration. Lower lease payments can free up working capital for fuel, payroll, insurance, and other day-to-day expenses. Buying locks in a fixed payment, but higher amounts may squeeze margins if revenue dips unexpectedly. On the flip side, equity buildup from buying can strengthen your balance sheet and improve borrowing terms over time. You might qualify for better interest rates on future equipment loans or secure more favorable credit lines when your owned assets grow. Credit requirements and down payment expectations also differ. Captive finance arms and major lenders often offer promotional lease programs at attractive rates for new trucks, while independent lenders handle used equipment finance with more flexible underwriting. Buying generally requires a down payment ranging from 10 to 20% and a strong credit score. Lenders will look at business history, financial statements, and personal guarantees. Leases may welcome lower credit thresholds but can demand a security deposit and impose end of term conditions that you must plan for. Tax treatment varies based on your structure. Enterprises can deduct lease payments as operating expenses, while equipment loans allow depreciation write offs through capital cost allowance in Canada. Interest expense on the loan is also deductible. Ownership offers greater write off potential over the life of the asset, but requires careful record keeping and adherence to tax rules. Leasing simplifies deductions by bundling payments into a single expense line. Consult your accountant to weigh the impact on your taxable income and cash flow. Maintenance and flexibility are key operational factors. Buying means you control maintenance schedules and shop choices, but you shoulder unpredictable repair costs. Leases may bundle service agreements with fixed rates that protect against high cost failures and ensure compliance with safety standards. Telematics and safety technology upgrades are typically included in modern lease packages, helping you meet regulatory requirements more easily. Ultimately, the choice between leasing and buying comes down to your business model, growth plans, and risk tolerance. If you value the freedom to own, modify, and resell your truck, and you have the cash flow to support higher payments, buying likely fits your needs. If you prefer lower upfront costs, predictable expenses, and regular upgrades without the burden of disposal, logistics leasing may be the better route. Many owner operators find a hybrid approach works best, owning their core workhorses and leasing additional units for peak demand seasons. Whatever strategy you choose, Mehmi Group is here to help you compare lease and loan scenarios side by side. We'll present total cost of ownership analyses, cash flow projections, and tailored term sheets so you can make the smartest decision for your fleet. To get started, visit mehmigroup.com and complete our quick finance form. I'm Haider Malik. Thanks for listening, and here's to finding the perfect fit for your truck financing strategy.